This conference will now be recorded.
Good morning. This is Frank, Clueless A Trading. We have a great member who's learning the tricks of the trade, if there are any tricks, but at least learning the methods of technical trading. We have Mike here in attendance. It is approximately 10:09 a.m. on May 18, 2019. Uh, this session will be recorded and uploaded to the Google YouTube channel for further viewing. Your link will be sent so you can tap on that and connect with the uploads when they're done within the next day or so. Full disclosure, this is purely for financial education, not for any solicitation or advice, and let us begin. So Mike, one of the things I want to do today and spend some time on, which is very important, is talk a little bit about explain to you a little bit about the dynamics of these patterns that keep on replicating themselves in the market, and I show them all the time on my charts. So
hmm
that'll give you a little bit of a better understanding when I'm putting out the posts out there as to why, what the basis, what the technical basis is on getting into a trade and such. Now, keep in mind the technical analysis on itself, Mike, is not a panacea to everything. It is not just like anything else in life. It is not something which has which has 100% efficacy record. But what it does do, especially in volatile markets, it gives us a sense of where we stand despite the rapid fluctuations on the volatility side, which we are, getting very accustomed to. And I've been doing this for a while, so I'm very accustomed to volatility. Volatility in itself can can and screw up technical patterns on a short-term basis. And it seems like, okay, there's a perfect technical setup, and look, we just got a news flash or a tweet or something that came out, especially in these extremely volatile times that we are encountering with all the different things that's going on. Um, and, uh, and 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 things go, things go haywire. But regardless of that, it is extremely important to keep in mind that over a period of time, and especially on the intermediate and longer term charts, these technical patterns work out extremely well. On the shorter term charts, which are basically the intraday movements on stocks and markets, obviously these things can get skewed. So saying all that, the purpose of this session is, and it's an important one, is to give you a thorough understanding of these patterns which are constantly recurring, so that when you're looking at my tweets and my alerts, at least you'll have a better understanding of what's coming through. Fair enough?
hmm Yes.
Okay, sounds good. And I'm going to give you what I'm going to do is when I'm looking at these patterns here, and I'm going to give you the basis, the sort of the behavioral basis of investors and traders as to why these technical patterns occur. So let's start off with the first one. I think I have, let me just change the color. Okay, there we go. One of the ones which is a bullish pattern, because technical patterns are either bullish or bearish or in between, but mostly they're bullish or bearish. They're never textbook perfect as they look on the pictures, but when you look at my charts in many cases, you'll see that they are similar. They have a similar shape to it, and that's what it's all about.
hmm
So first one, this is a bullish pattern. This is known as an ascending triangle, and an ascending triangle primarily is for longer term swing trades, or looking at the market beyond this 1 day or 2 days. Then an ascending triangle does not occur on an intraday basis. This happens over a multi-day basis or a multi-week basis. And this is simply when a stock shoots up. Do it here. So here you have a market or a stock basically that starts off its journey from some deep down lows, and shoots up really hard. The first move, what we call the impulse short covering heavy duty 300 point type of move in the market, for example, or a stock goes up two, three, four, $5, is always the fastest and the longest, generally speaking. as you're coming off these crash lows and these horrific lows when no one wants to really buy, and that is the time to buy. And it gets up there. You have intense short covering. You understand the concept of short covering, right?
Yes.
Exactly, because the stock might have been here and probably fell hard. Whether it's stock or market, it's the same thing, and you see this happen quite often. And there's a lot of panic selling that happens here. At one point, it becomes extremely oversold. Now, before I go any further, one of the things that I want to point out is when we're looking at technical patterns, we're just looking at the externals, right? Externals meaning we're looking at the stock chart. There are two things about technical analysis. One is internals, so I'm going to put INT, and one is external. The external is the stock price movement, what the stock price is doing, okay? And that's the external. Now, some people completely, traditional technical analysis in most cases, and most of the other trading services and stuff, they only teach you what's happening on the external basis. They always say just look at the price action and look at the volume that is accompanied with it. It's important. And in the old days, it was the only way to determine whether a stock or the market would go higher or lower. It's different now. It's been different like this for more than 5+ years, primarily because the machines are constantly pumping in volume and sucking out volume, which creates intense volatility. So yes, it's important to keep that in mind. However, it is not the only thing that will determine that. So the externals, the price movements, and if somebody's just following the price movements on itself, they'll be going in and out of something and missing out on what's going to be coming. And this happens all the time. That's why on a sell-off, you see a push down harder towards certain levels, and then within the next day or so, or within the next hour or two, depending on an intraday basis, you see a sharp move higher. So in order to understand a sort of stay calm, that's basically the whole essence of trading, is you have to look at the internals. The internals are one of the simplest ones that I use, and ones that you are becoming accustomed to is the stochastics, for example, which shows you the overbought, oversold conditions. You are, you know what I'm talking about, right? I call it the STOs. Okay.
Yes.
So the STOs, when they get really oversold on a certain time frame, you generally get a reflex bounce. That bounce basically gets sold when it gets overbought again. And I have noticed that during these very volatile periods that we're going through, this overbought, oversold conditions is a pretty good indicator as to when to get in and when to get out. And it's always been the case, but now it's more so because of the movement in the markets are so rapid. Now, saying all that, the way I explain it is that if it's like going to a doctor. Okay, the externals are, you got a sniffle, you have a cold, whatever. You go to the doctor looks at you, knows something's wrong with you, but before he goes ahead and prescribes some heavy duty antibiotics or prescription medicine, he wants to know if there's anything else that is beyond the surface of what he's looking at. So the surface part is the externals. So he goes and puts out a laundry list of blood tests that you got to do, and when that blood test comes, the doctor calls you in again and then says, okay, this is it, everything looks good, or hey, detected this, I'm going to give you that. That is what we call the internals. Fair enough. The external is how you're feeling and looking, and the internals are your thorough blood test to give you an indication of what goes on. Now, mixing these both generally tend to be a lot effective mechanism, both in investing and trading, and so I just wanted to point that out. All right. So okay. Now, the ascending triangle is a bullish move. The first move is always the fastest and the longest because there's heavy duty short covering, people getting excited like, wow, look at it, it's really on the move. Generally speaking, as tactical traders, we will be buying a little bit ahead of this move here based on the internals, which might be extremely oversold. And I'm showing those arrows underneath showing that this is going to have a reflex bounce. This is the point that 99% of traders don't buy because they're like, oh my God, look at the price, it's just plummeting. But this is the time to buy based on the internals. Generally speaking, the average trader who is just following prices, tends to buy at these levels. And once this jettison moves, this move price jettisons this fast and furious, you get profit taking. You get profit taking. That profit taking creates another move down, and then that's what they're showing here. And then you get a second level of buyers who missed out on this move come in. They push it up. The moves are getting smaller and smaller because the stock price or the asset price is climbing faster. It gets narrower and narrower. And at this point, some of the more excited traders will be like, yes, we're getting in here. Look at this. This looks like, it's really going to break out. And on a bullish front, you tend to get, if it keeps on hitting more than 3 times on the top, it tends to have a breakout. I have identified ascending triangles many times in my career and over the past year, 2 years, and ascending triangles over a longer period of time are a very effective measure. It keeps you in the trade. Obviously, the best time to get in is at these levels, and then it breaks out. It normally comes back to retest this breakout again. Happens all the time. If the breakout holds, this breakout level holds, you see me put that comment down, then you'll get another move higher, and then of course you move on. Now, the downside of this, which they're not showing here, is that you could get an ascending triangle which gets narrower and narrower depending on the internals underneath the surface, whether it be the stochastics, whether it be the MACD. We'll cover that stuff on the next session. You could also have a pullback. These are known as consolidation channels. That pullback sometimes is called a bull flag if the primary trend is still higher. Okay, and stop me if I'm going too fast. So this could be a profit-taking bull flag, but depending if the internals keep on cooperating, then this will move higher. But you also, which they're not showing here, get one of these. It is nothing wrong with that. It allows you a chance to get in. However, as it gets narrower and narrower, there is a lot of nervousness as to what's going to happen, and this slight pullback causes the people who bought in really late to panic, to sell, and that causes a quick, sharp downward movement. So that is the other side of an ascending triangle. Fair enough?
Right.
Okay, so we're covered with that. Now, this is a bearish pattern. This is known as a descending triangle, where you are making, stock is coming off a much higher level, just the opposite. It attempts a bounce. The bounce fails. It comes down. It retests that double bottom. It tries to go higher, creates a lower low, and then hits that floor again. And generally speaking, after the second or third try, it will succumb to breaking of the floor, known as a double. There. Okay. You there?
Yeah.
Yeah. You have a little allergy or?
Yeah, I had a little sneeze attack there.
Oh, okay. No, that's fine. So and then it breaks down. The key to keep in mind about these descending triangles is the fact that it is creating lower lows. Now, sometimes we will play these moves, and play these moves which are very sharp and very quick. But generally speaking, lower lows connotates that you are going to basically have a break of the support or the floor, and it's going to come down. Now, just like on this one, I showed you the opposite of what might happen. Let me show you the opposite of what can happen with this. The opposite with this is that if this floor keeps on sticking, then you get a sharp breakout higher, and that is shown as this, known as a term that you've seen me use, is a falling wedge. Okay, falling wedge. In other words, what happens with this is The people who came in short, trying to short the market, people or hedge funds or whatever, the machines, they're shorting the market here. However, the market's not breaking. This floor is sticking. They panic as there is a minor move higher. That panic causes a sharp move higher known as a falling wedge breakout. So there is no guarantee per se that a descending triangle will certainly break down or create a false breakdown. Bottom line is that they get really scared. They're like, oh my God, I shorted here. Now I'm going to lose my money because it's not going down anymore. This floor is sticking like a rock, and there is a sharp short squeeze higher. That's known as a falling wedge. We're going to cover that in a second. You understand this part?
Yes.
Okay, sounds good. Let's move on to the next one. The next one is basically, it's known as a triangle pattern, where a stock price or the market moves. It gets narrower and narrower, lesser and lesser people are participating, price movement is getting contracted. This can go both ways. This can go higher, this can go lower. Now, if somebody was just simply following the external, okay, keep that here, the stock price, external, and the internals are basically the indicators, the waves of oversold and overbought conditions. If somebody was just following the externals, Mike, we wouldn't be able to predict as to what is the probability, what are the chances. Do I have a better chance of, is there a better chance that it's going to break out, or is it going to be is it going to be a breakdown? So the way we try to determine it as best as we can is we look to see internally what's going on. If it's a very oversold condition here, then the chances are that you are going to get a move higher. So that a triangle formation can resolve itself both on the upside or the downside, but that depends on a very sharp reading of what is happening internally with the internal indicators. You follow me so far?
Yes.
Okay, so when I'm putting out something like that and I'm showing you the internals and at that, and I'm saying, okay, I'm going to go long on this here, then at least you will have an idea and base it on your own final decision as to whether or not this is worth the shot or whether it's going to be breaking down. So that's your triangle pattern. Let's move on to the next one. The next one is something that you're quite familiar with, which is a bull flag. Stock moves up or a market moves up, then it goes into a consolidative phase. This is what's happening now, where we basically stay within this range. It creates a flag. There are ups and downs back and forth within the flag, but the general primary direction of the price is still higher. Of course, you have, we are showing at the same time, we are showing again not just the price movement on the external prices, we're also trying to get a good read of the internals as to whether or not this is a bull flag. And bull flags generally resolve themselves higher based on the primary direction of where it's coming from. So the bull flag is a profit-taking channel, and again, this is a very tricky one in the sense that you don't know whether or not the bull flag is going to, if somebody's just looking at it, there's no guarantee a bull flag is going to break out. It could turn out to be a breakdown, a false breakdown before it reverses itself higher. But these are known as consolidation channels, and I try to draw them as precise as possible. In most cases, I've been correct on these, but that's what it's all about. It's this is known as a they're calling a channel down. It is basically a bull flag. Okay, so you're good with that, right? I've explained this one before quite a few times.
Yes.
Okay. This is the same deal, just the opposite of this. Stock comes down, then it starts to move higher, and this is the opposite of a bull flag. It's known as a bear flag. Now, bear flags are very difficult to read, and that's why, bear flags are basically telling you that, yes, we're having a bounce. The other name for a bear flag is a dead cat bounce. You've heard that term before, right? Dead cat bounce. And basically, that's what a bear flag is, a dead cat bounce. Now, a dead cat bounce is something that generally resolves, again, towards the direction of the original trend. And this is a dead cat bounce happens because the shorts who shorted here, let's say it was at 4, it's at 2, they just made themselves 100% on their money, right? If you're short on that particular trade, and so they cover here, it starts moving up, they keep on shorting as it's moving up, and then it breaks down again and hits either the 2 or falls below the 2, in which case they obviously made more money. But the reason why it starts to move higher is primarily because of short covering and some new traders or investors getting into it because they feel that it is cheap or very oversold at that point. Now, the opposite of the bear flag is this bear flag could morph and move higher big time, and that is, again, we try to read it very effectively through reading the underbelly of the charts, which are the internal indicators. The bear flag doesn't mean that it's going to be a breakdown. It could also mean that it's going to break out, but that is determined primarily by studying the oversold, overbought conditions and the other indicators that we follow. Now, this is the other factor that happens in the reality of the market that they're not showing you here. So here is the channel that is climbing, looks all good, but it could be a false move higher before it breaks down. Could break down, retest, and this happens a lot, retest that low that it hit and creates a very sharp double bottom, in which case it morphs into that W pattern, which we have seen many, many times, and that W pattern, and of course in the reality of the market, it's a lot more zigzaggy, but still that W pattern morphs itself into what is known as a dragon bullish. Now, I don't make these terms up, but that's what they call it. Okay, it's basically a W pattern or a double bottom bounce, and that is known as which generally goes to where it fell from, and then if it really wants to goes to the top of where the original fallout was, what we call a pattern completion. A pattern has been completed. So you do not want to necessarily buy very heavy at this level. I generally tend to be buyers when things get rough and, tumble, and then I sell along the way, and I don't necessarily wait till it hits the upper end of the move of the range, which a lot of selling will come in because the people who were trapped here, they're like, oh my God, I just got my money back. Let me sell out. And, and that's what becomes a resistance or a wall. Are you with me so far?
Yes.
Okay. So that's the other part of the picture, that a quick, sharp move down can create a very strong double bottom and a bounce, and it becomes a W pattern. And these are pretty big money makers. And this happens both on the shorter term as well as on the longer term picture. But given the volatility of the market, it's happening a lot more on the intra-week basis than on an intra-month basis because of all the unknowns and stuff that's happening in the market. All right? So keep that in mind. Okay. This is the falling wedge. The falling wedge is a very, very powerful pattern that non-technical traders who are just looking at prices can never figure out, and it's a very powerful opportunity to make some really good money over a short period of time. What happens is a stock is falling or the market's falling. As it's falling, the range is getting narrower and narrower. The internals are getting deeply, deeply oversold, and they are and the ones who are just looking at prices, they are simply saying, this is it. This thing's really going to break down. That's it. I'm going to keep on shorting here. They didn't short here. They started shorting here. They start shorting there. And they're buying puts heavy. And guess what happens? And that happened quite a few times last week, by the way, okay, where the market looked like it was just going to go, and boom, it goes higher. Okay, so what happens is there's a big concentration of short positions in the form of options, in the form of shorting the market or the individual stocks. And what happens is when it gets to this level, there are a majority. Remember, the markets always like to hit the levels where most of the concentration of traders are. In other words, if majority of traders are very short on the directional bet, the markets over the short term will basically attack that level, the machines will attack that level because no one wants to pay anybody, right? That's just the way life works. So the market doesn't want to pay you. So the machines will go to work and create a very sharp short squeeze, and you get blasted out because you came in late on the short. Now that also, the readings are done on extreme oversold conditions, and I've shown that many, many times. So bottom line is, this is known as a falling wedge, where the prices are falling, but they're getting narrower and narrower in range. A lot of non-technical traders are shorting it here, and then you get that big fat short squeeze. This buy program comes from nowhere, and then you get a very sharp move higher. Okay, so that's known as a falling wedge. There, they actually use that term. Okay. Now, the rising wedge is another one which happens in the markets over both a shorter intermediate time frame as well as on a longer time frame. A rising wedge it's climbing, the prices are getting narrower and narrower, and we have seen this happen quite a bit. And then the rising wedge is not necessarily bearish, but you get that sharp profit-taking pullback, and that is the shape of this is still a bull flag, but a rising wedge generally, as the prices get more concentrated and the internals are getting quite overbought, you tend to get a quick, sharp corrective move or a correction or a pullback, and that creates, depending on the overall direction of the market, creates. I used to jokingly call it a galloping horse pattern. It looks like a galloping horse. It looks like a horse, right? So horse is it, and then it breaks out. That's a bull flag. So a bull flag can occur off a rising wedge, and it again, all the different support levels and stuff come into play. That's a separate story. But so this is known as a rising wedge. A rising wedge generally tends to correct. A falling wedge tends to correct on the upside, and this will correct on the downside in the form of heavy-duty profit taking that generally occurs very quickly. So that's your rising wedge.
Okay.
Now, these are easier to understand. This is what we call range trading. I do this a lot with individual stocks. Remember, not every stock, most stocks in different sectors will have a certain face to it or a structure to it. And for example, you look at the HMOs like United Health, which delivered some very strong numbers for us. United Health, Humana, these HMOs, health insurers, they are coming off some sharp bottoms, and UNH is looking really good. So is Humana, lots of upside, even on a day like Friday. While the techs were down, those things were just shooting up, and so those are so it all depends. Some are trading within a range, some are creating all different types of patterns. So this has to do with the simplest formation, which is a stock or the market trading within a range. You sell the upper end of the range, you buy the lower end of the range. So the rectangle, depending on, and again, you have, that's my job to do, is to point out the internals as to whether the range is going to break out or whether it's going to break down. So range trading is just as it says. If it's trading between 10 and $5, so you want to be buying close to the 5, 6, 7 level, selling close to the 10 level, and it's just simple back and forth within a range. Sometimes the ranges are tight, sometimes they're wide. Now, over a period of time, and I've shown this in my videos too, over a period of time, let's say this range lasts 1 year like this, a stock is moving between 5 and $10. I'm just giving you a small example. They say the longer the base, the higher the move, higher the prices. In other words, the longer it stays within a base and then it has a substantial breakout, the chances are that it is going to break out to higher levels. Now, one of the simplest ways to calculate that, it's old-fashioned way, back of a napkin calculation. You look at the depth of that range, which is 5, right? The depth of this range is 5.
Right.
And you add that, and it's a rule of the thumb on this, especially on swing trades. And so then you add that 5 to the breakout on this range, and that becomes 15. You can do this. Yeah. So now, if you can't necessarily do it from the downside, because the downside, if it breaks down, if you're saying that you're going to take 5 off 5, that means you're going to 0. Now, a solid company is not going to go to 0. You know what I'm saying? Right. So just keep that in mind. This formula works. The range breakout formula works for a breakout where you measure the depth of that range, and then you add that to it, and generally speaking, 80 to 90% of the time, it will get there. It will get there. Right. And so that's basically this rectangle. Let's move on to the next one, which occurs a lot over a short-term period, over a longer-term period too. They are much more difficult these days because the machines are changing technical patterns rather quickly over short-term basis, very quickly, and on an intermediate-term basis too. Even on the daily charts that I show to keep people focused on the bigger picture, these patterns are shifting a little bit quicker than normal, primarily because of something we cannot control, because of the random volatility that hits the market on a daily and intra-week basis. Saying all that, this is a head and shoulders. You're quite familiar with that. You get a head, sharp move higher. This is the left shoulder. This is the right shoulder. This is a neckline. This is the neckline, actually. That's the baseline, and it jumps off the neckline, falls again. Whichever the case, if it breaks this level here, that means there is going to be further downside. So that's a negative pattern or a bearish pattern. So that's a negative pattern. Okay, it's a head and shoulders is a negative pattern.
Yeah, you told me you call that the FU pattern.
I call that FU. Yeah, right. It's like flipping the birdie. You remember all this stuff, I know. Yeah. So it's basically a flipping the birdie pattern. Yeah, exactly. And so the thing is that what they're not showing, that this can morph into a very bullish pattern if the shoulder is taken out, and that has happened. The shoulder's taken out, then it's going to be creating then it basically will head towards, or at least attempt to head towards the original head of this head and shoulders, and that's very bullish. So again, the internals dictate in most cases, if they're extremely oversold at these levels, then there's going to be a sharp bounce. Sometimes, and this is what happens quite a bit in these type of volatile markets, the right shoulder is broken. The breakout over the right shoulder is taken out. Happens. What we call, it negates the bearish formation, right? It cancels the bearish formation because the right shoulder is taken out. But again, it might create a false breakout. It might fall back in the shoulder again, and that causes further selling. So that's, it's just the way it is. But it's a negative pattern overall. The opposite of that is basically, and I haven't come up with this is a non-FU pattern, I guess. This is I don't have a term for it. If you come for a good one, you're pretty witty, so let me know. So this is your inverse head and shoulder. It's an extremely powerful pattern, occurs on an intraday basis, occurs on an intra-week basis, and over a much longer term basis also can be detected. But again, we are not playing our trades for years, for 6 months to a year. So we want to keep an eye on the closed picture, but this is what it looks like. You get a big head, you get this move up towards the neckline, pulls back immediately the neckline, which happens a lot, almost like 100% of the time, and then retest this level. Now, in the reality of life, it's not exactly the same level. Sometimes it's a little bit skewed. Most of the times I see it like this, okay, where you slant it a little bit. There you go. Okay, that is the reality of the market. This is textbook. This is the reality of what happens. It'll slip below the right shoulder, but the formation is still looking pretty good. This part is a W. This overall picture is a inverse head and shoulder. Now, somebody says, well, how do you know exactly? Well, no one knows exactly. As I do this more and more, just like your profession, you can detect things on your profession a lot faster than somebody, like, before it sometimes happens. So you train your brain, and I've been looking at charts for so long. I'm working on this stuff that it becomes almost second nature to start seeing this, and I call it sometimes a complex head and shoulder. I mean, inverse head and shoulder. I said, no, it's still looking like a head and shoulder, and of course, I look to see underneath what's going on a lot. Many different indicators to make that determination. So this one is a little bit trickier for the average person because it looks like it's going to come back and retest those lows again, but it doesn't quite get there, and it just takes off. So that's your inverse head and shoulder. So there you go. I call it IHS. You'll see that, so the IHS is the inverse head and shoulder. This is a triple top. The triple top is overall, again, same like this, the rectangle. Overall, if you look at it, the market does, like, if you look at it from a broader standpoint, like a multi-year standpoint, the market overall has created a triple top. Whether or not that triple top is going to be broken, no idea. If things work out on all the different political and economic fronts that's happening, a triple top will be taken out, and there's going to be substantial move higher. But for now, just got to keep that in mind. It keeps on hitting the same floor and coming down. Obviously, the market doesn't want to go higher at that point. It gets stuck in a range. This is a triple bottom. It's the same thing. You flip it backward. A triple bottom is a very powerful bullish formation. That means this is the level that the stock won't break. Now, let me point out something here. It's a very simple concept, and a lot of traders don't get it. That if we are buying something, we might need to have a little patience, but if we're buying something on a substantial triple bottom, which has a length of time which surpasses weeks and months, that's the important part. It's showing you that it does not want to break this level. That means there is a very solid floor. That's where the fundamental managers who don't follow technical stuff say that's the price that we want to get in. That's the price the stock is valued at, a very reasonable price or at a bargain price. And a triple bottom identification, sometimes, like this is textbook, but it sometimes can be like this. Little slanted, is a very powerful entry point. Now, the stock that has created a significant overall triple bottom, double bottom is Boeing. So regardless of intraday moves up and stuff, if you look at the longer term chart, you'll see a level that it bounces off a lot is basically the 350, 360 level. it was holding the 360 level very well. And basically the 360 level, once it breaks above that, you're going to see a substantial move higher towards 375, 380. So basically large cap stocks tend to exhibit this not phenomena, but this characteristic of creating a significant triple bottom. Could be slanted like this too, but bottom line is that it's creating a bottom within a range. It doesn't, you can't have a bottom all the way down here and call it a triple bottom. That's not a triple bottom, that's a breakdown. But generally speaking, if a large cap stock is within 10 points of this type of slightly slanted bottom, it's fine. And of course, mix in the other internals and everything. We're just giving an example. So triple bottom is a very powerful formation to enter, to hold that, to roll it out a month or two, whatever the case, and monitor this. So this worked out very well in many cases. This is let's move on to the next one. Already explained this to you. This is a bull flag. This is known as a pennant, which is a bull flag in a triangular form. Okay, so a pennant, bull flags, these are the same. Pennant, bull flags, they're basically the same. Now, we're good with these basic patterns, correct?
Correct.
So, okay, 1 second. I'm going to pull out now. Now what happens is what happens in the reality of the markets is that patterns, I think I found the one to show you. 1 second. They tend to overlap themselves as they're happening, and I think I found one. Okay, looking through. So what happens is they overlap themselves and they become, and they become more difficult to read. So here is a quick synopsis of a look. That's a double bottom, but in between there's all kinds of different patterns that are being created. See that? So I just want to give you a quick snapshot. This saucer base is a very powerful pattern. We call it a cup and handle. This is an ascending triangle, but it's moving in curves. It's not like a triangle. It's ascending base. Then you have these double bottom pullbacks of higher levels, and everyone freaks out. And yet it's all this is doing is it's moved up and it's moving within a range, and then it breaks out. So all these things happen quite a bit. Now, saying all that, the one that that you are quite familiar with is the cup and handle pattern. So I'm going to show you that. See, that's a consolidation pattern, similar to, you can use that for intraday trading. You can use that for longer term trading. There's your inverse head and shoulder. And let me try to type in cup and handle. Cup and handles work extremely well on longer term charts. One of our biggest winners, this is before your times, is basically was Chipotle. I had identified the cup and handle way before it happened. A cup and handle, lots of back and forth, but you start to see a formation. Now, these normally, the ones which work out the best, Mike, are the ones which are over a multi-month period. There's your cup, then your consolidation. So this can also be looked on as a bull flag, multi-month bull flag with a lot of zigzags, and then it creates a pullback, right? and then it tests the neckline. On this chart, I'm going to show you how many patterns are repeating themselves. See, there's inverse head and shoulder, right? There's your neckline. There's your neckline. The breakout of the neckline caused a big move higher, which created a small bull flag right there. Breaks out of the bull flag. Lots of activity here as people get super excited, and then bang. The ones who basically bought off these levels, bought off the breakout of the neckline, they start selling. Creates a sharp pullback. In this particular case, it went from 42 to 37. That's a sharp pullback for the $42 stock. Creates some heavy duty oversold conditions. All it does, it tests the neckline. This is what it's doing. All it does, it tests the neckline or the previous breakout. If the previous breakout holds, you're going to see a sharp move higher. That is exactly what happened here. So the point that I'm making, that I'm putting, as I show both swing charts and the short-term charts, and we're gonna look at a real life picture of Zillow, why I'm bullish on it, and so you understand it, and then when this moves higher, it's a very sharp move higher. There is your second neckline. Then you use your back of the paper napkin calculation that I just showed you, and look how good it works. Watch. What's this price, Mike? 42. Okay. One second, sir. There was your neckline. What's this price? 37 roughly?
37.
Yeah, 37. So you might call this a range. If the stock hadn't fallen below this, you would call this a range.
Range.
Right. A trading range over multi-months.
Multi-month.
Right? You're with me so far?
$5 range.
$5 range. Thank you, sir. Add the 5 to it. 47.
47.
And that's what they're showing. Yep. So this is what happens. So let's look at another range. What was the range here? 31.
About $5.
$5, sir. Add the 5 to 37. 42. Where the next breakout happened. So these do happen. This definitely not 100% guarantee, but I've seen this happen quite a bit. These are more on longer term swing trades, and they do happen. So just wanted to show you that. So now let's take a real life example. And I think at least for today, as we covered the external price patterns and stuff, you got a good understanding on these different patterns that replicate. It took me, look, just to give you a little background, I was never on the technical side. On Wall Street, I wasn't a professional trader. I was a fundamental research and institutional sales. In other words, we looked at companies, we looked at different assets, what to go into a fund, and then we would bring it to small pension funds. That's what we dealt with, and said, okay, this is what we think. This is what you guys should place it in, and then so that was the so we bring them in as clients. We also dealt with high net worth retail clients, setting up their portfolios, managing their portfolios, and stuff like that. However, I always was deep inside the market. I really want to understand like what this market did, what it did. Being on Wall Street from 1996 to 2000 and almost end of 2010, quite a few years, I got a chance to basically meet and be at these major technical seminars and stuff run by some of these big guys who are still around. Ralph Acampora, Tony Dwyer, who's one of the best technical analysts out there. You see him on TV. He was just on CNBC the other day. His track record has been terrific. There was an older lady, she's still around, I went to a couple of seminars which she ran on Wall Street for Wall Street professionals. Her name is Louis Yamada. So all these people, so I got a chance to, okay, this is interesting. So I learned the basics of technical analysis, and then as I started to use them on my side, I started to adapt to this new world of looking at it. The basics don't change, but you got to adapt to this new world of machine trading. So I started to draw my structures on top of it using the same format, and that's how I'm evolving. I am still adapting. I'm still trying to tweak and get better and better, and so that's where I'm coming from when it comes to technical analysis. Now, why do I think that my technical structures and stuff that I draw on charts work a little bit better than the traditional way? Because the machines are running the market. It's as simple as that. And I'm looking at I'm looking and drawing those lines and those patterns and stuff based on the reality of what happens, not pushing the traditional technical analysis principles on and saying that's it. It must happen that way. No, it doesn't have to. So that's why my charts are more evolved in what's going on. So you understand that part, right?
Right.
Okay, very good, sir. So let's take a look at real life example, and we are going to look at we're going to look at
You're familiar with the book Art of War?
Sun Tzu, of course.
And the primary lesson in there is know your enemy.
That's correct. That's correct. And the other one that I remember, I have to reread it, is when your enemy is strong, pull back. I mean, I'm saying it in my simple terms. And when the enemy is weak, plunder. So basically that's it. When your enemy is strong, you don't want to be dying. So you want to withdraw, strategize, and exactly right.
As General Douglas MacArthur said, there's no substitute for victory.
There you go, sir. That's what we strive for every day. That's excellent. That's excellent. Exactly. There is no substitute for victory, because victory leads to confidence. And the way I look at it, confidence is contagious, and the way I look at it, misery loves company, and confidence is, they do. I mean, I could. There are services out there, and a lot of people, all they talk about is the bearish movement of the market. In the meantime, the market since 2009, when we made that climactic multi-decade low, has been going higher in between all types of movements. But the bearish story, I mean, the misery story sells. Bad news sells. Good news generally doesn't sell. They're like, okay, we knew it was going to happen. Bad news is like, yeah, I told you so. That's why you get this doomsday scenario, guys making millions of dollars, just telling a story of like complete doomsday. The way I look at it, when doomsday comes, there's no story to be told.
Yeah.
So it's going to be over. And scientifically speaking, when the huge asteroid hits us from wherever, that's it. That's how the dinosaurs got extinct at one point. You got a big fireball coming in from the sky. So anyway, so saying all that, let's take a good look at this chart here, and let's try to pinpoint a couple of things happening here, which is exciting. First and foremost, when you look at this chart, and this is going to be interactive, so answer my question. What's the first thing you're looking at in all these different lines that I'm drawing? What's the first thing that catches your eye, sir? It doesn't have to be prioritized, but
a channel.
Which channel are we talking about? This one?
No, the green bars going up.
Oh, this green bar.
No.
Oh, the green bar is going up. You mean, where's the green bar? I mean, this is white, this is blue.
Right there.
This one?
No, one above it.
This one.
Okay,
and then
the green bar below it.
This is what
down.
Oh, and this one. Okay. So you're looking at gotcha. So you're looking at this channel here. That's the first thing that caught your eye.
Yeah.
All right, that's good. Okay, so you're focusing on this channel that is a multi-month channel. It's 5 months old, 6 months old, It started in November, and we're in May, correct? So
Mm-hmm.
it's 6 months old. Very good. So you're looking at this. I'm going to use the highlighter. So you're looking at, and you see how it just amazingly hits the bottom of the channel before it makes a sharp move higher. Okay,
Mm-hmm.
so you're looking at this channel. Upper end of the channel is $42.50. Lower end of the channel is $32.50. So you got a $10 move here, which if you look at the depth, so we're talking about 10. You're with me so
Mm-hmm.
far? So
Mm-hmm.
let's add 10, just like we did with this is a same thing as a rectangle, except it's a slightly more positive because it's sloping higher. So we got 10. Let's add 10 to 42.5. We arrive at 52.5, which lands us in this big gap fill that is looming above. One
Mm-hmm.
way or the other, I'm not sure what time frame it's going to take, but I don't think, and that one way or the other, it's going to fill this gap on
Mm-hmm.
the daily charts. Okay, now that's a pretty substantial move. It's a move of roughly 25%, 40 to 50, right? So 25%. So
Mm-hmm.
25% for a company like Zillow, you need to see something along the way. There's going to be a lot of resistances. So let's
Mm-hmm.
take a look. So that's the first thing you looked at. Very good. Now, you see the basis of me drawing the channels. It's the points of contact, and then I drew this line, and that automatically is where the stock stopped going down and started to move higher. All right, and
Mm-hmm.
and the stock, basically we bought it before earnings. The stock popped up big time. It was a bad day in the market, and the next thing you know, it created a very large red handle for no reason. Look at the
Mm-hmm.
volume. That was a big capitulation sell that created a substantial bottom within this channel. Yet one of the things that I noticed, that despite that big volume reversal, big volume reversal, you did not see a collapse on the internals. See,
Mm-hmm.
this was the quick pullback on this large volume. I mean, somebody who is just looking at price and volume will say, oh my God, it's over. 20 million shares were dumped. 20 million shares were dumped, and the stock is over. Yeah, right. It went from 35 to 40 every single day and will continue, in my opinion. We're going to discuss that in a minute, towards these levels here that we have pinpointed. So price and volume itself doesn't tell you much. So that's
Mm-hmm.
one thing. Second thing to keep in mind is this type of volume is normally associated with what we call panic capitulation. Some hedge fund blew up, people just panicked and sold. A capitulation volume, which shows up very clearly on any chart, look at that,
Mm-hmm.
generally connotates a short-term bottom, this type of capitulation volume. And that is exactly what's going on. That means whoever needed to get out got flushed out. And capitulation volumes are great buying opportunities, as you can clearly see here, because there is really, shouldn't say no one, but the majority have sold. So the new buyers who came in, or the sharp money who was buying that low, they're like, fine, let it go, because we don't, the sellers are out. So it's a nice flush. It's good. So now, the second thing that we're looking at on this chart, aside from that wide range, is we are looking at a secondary range here. See this white line? See this white line?
Mm-hmm.
That white line was the last time the stock hit and started to come down. That's exactly where we hit on Friday.
Mm-hmm.
Now, somebody says, well, what do you expect it to happen? Two things. It could do this. Could pull back a little bit. Okay?
Mm-hmm.
Create that left shoulder, right shoulder type of move, and certainly will be buying on that. Remember, these calls are for June, right? So the bottom line is, so ample time left. It creates that, and then it makes this move. See this move here where the stock fell from 45 down to 37?
Mm-hmm.
One way or the other. And I believe this pullback, again, no guarantees, it could just break out and go straight out. But if this pullback does occur, it's like a slingshot. It builds up kinetic energy before you let it go. You know, somebody says, why do markets pull back? Well, markets freaking pull back because it needs that extra kinetic energy to surge forward, to bring in new money. If markets always went up in a straight line, nobody would make money because everybody would be buying higher and higher, and then at one point there's no one left to buy. And that's generally what I keep on talking about, because I've been doing this for a while, is where markets make the ultimate tops, like a multi-year top. When everybody gets in, cash levels are minimal because all the money, pretty much all the money that needs to go into the stock markets have already gone in there. It is exactly the opposite on a bigger picture now. Majority of hedge funds or institutional managers are sitting in piles of cash making 0%, yet every single day there's some opportunity in the market to make money on certain stocks or the overall market itself. So bottom line is bull markets don't end with that type of pessimism, which shows up in the level of cash levels, which is at some historic levels at this point, just sitting there. Where's that cash going to go? They are meant to go in the market, but if they're not in the market, they'll have to come into the market at some point. So, and they've been doing this for years now. So that's the reason why, there is a basis that bull markets don't end on a whim. They generally end when majority are super excited about it and the cash is in there. So just to keep in mind. So let's talk about technicals here. So at this point, this is pure pattern recognition. Will happen. Okay, and then the big pattern completion happens at around 45. Big pattern completion happens around 45. That is not quite your 47.5 or so where that channel is. But let me ask you a question here. If there is a surge, just the way this is replicated, let's say it starts from here, or a minor pullback starts from here, whichever the case, the pattern is very clear. Internals are moving up nicely. When something hits that hard and there's a sharp move higher, it doesn't just stop at 45. There is an overshoot. There's always an overshoot, just the way there's an undershoot when things are selling off, right? There's that panic. There's a panic fallout, and there's a reason behind it. There's emotional panic. There is stop limits, which are triggered when somebody's like, institutions have that too. Like, okay, we're not going below that. Boom. That creates the next leg of the sell-off. That's what creates these type of capitulation bottoms. Happens in markets, happens in stocks. So saying all that, the opposite happens when you hit the buy limits. When they hit that 45, there's an overshoot. That overshoot should bring you to the original channel that you identified as the first thing, which is that 47.5. You got it? Exactly. Now, there is a secondary acceleration channel, these white lines that I've drawn. This is exciting to see that we have entered the first of this is channel 1. This is channel 2. See that? So it is exciting to see that we have entered into the uptrend channel number 1, which has a midpoint on the mid level of 43.38. This is pure technical. 43.38. You should expect to maybe see a little bit of selling at that level. Let me draw a line here, and you'll see why there could be some selling at that level. Watch. Second, let me clean this out. Make this a little bit there. Okay. See what happened back here in November 2nd. and October 5th, and that's when the market had really broken down, October 5th, around that time last year. So there were two levels of what we call supply, or big levels where the market it just basically couldn't go above, and big sellers came in, right?
Mm-hmm.
That level also happens to be exactly the mid channel, this one.
Mm-hmm.
See that right there, 43 and change, 43 and a half.
Yeah, and you were talking about overshooting. You have a good example of that big green candle of overshooting.
Major. I mean, that's like, that's those are those, how many dollars was that? 37.44. Wow. That was a $7 move in one day. We'd love to get one of those. You know what, we would. And the reason why we would, aside from the fact that it'd be just an enormous day, is the fact that this could happen on not just an analyst upgrade, uh, which it already got, but it could happen on a collaboration with a big company. What if Google says, hey, we're going to use Zillow for our real estate listings? What if Amazon says, hey, we'd like to basically showcase a lot more, we're going to like to use our algorithms, and we're going to use Zillow as our partner in real estate listings.
Mm-hmm.
You get those type of moves. That happens a lot. What
Mm-hmm.
if Apple says, hey, we're big into maps and stuff? Google's big into maps, and Apple says, you know what? We want to basically, it's mostly would be a Google, um, Amazon type of thing, or even Facebook. Facebook says, you know what? We're gonna show real estate listings. So there's a lot of these big companies who could do that, and you could go to $7 type of moves,
Mm-hmm.
big. And at that point, that's an exhaustion move right there. You see the thing, get excited, you buy it. Unfortunately, it lasts one day, and the next thing you know, it falls apart, right? So
Yeah.
one with the other, this is the pattern we're looking at.
Mm-hmm.
What we're looking at, and so the points where, as a technical trader, I'll be concentrating on is 43 and a half, 43.50, and then 45. If it breaks that, separate story. We're going straight into this gap. This is
Mm-hmm.
big. Okay, so you can see how many patterns. This can also be looked on. Well, I showed you this can also be looked on as a cup.
Mm-hmm.
There you go.
Mm-hmm.
The cup creates a handle at the 45 level. That's when it does the pullback. Or you can look at this cup right here, pulls back 1 or 2 points. Whichever the case, it's a cup
Mm-hmm.
in between inverse head and shoulders and stuff and all that stuff. So
Mm-hmm.
so I'm expecting, that if there might be $1 or $2 pullback, but that's a buyable opportunity as long as the internals are pointing higher. Now that's your daily chart. This is not a day trading stock per se. So if you look at the hourly chart, the hourly chart's a little bit overbought. Whichever the case, that's a good looking chart. Now, let me show you another one. Trying to remember which one fits the pattern. United Health, all right? Daily. Now, there's a couple of things happening here. Forget about this part. Let's focus from here. And then I'm going to wrap up. All right, sir. You'll be able to see this very nicely. There's been a lot. Somebody looks at this chart. Oh, wow, look at this roller coaster. Well, don't call it roller coaster. We call it technical pattern. This is a very large pattern that goes back to November of last year. All right, from this level, December of last year. So we're talking multi-months. Easier to see. This is a very powerful pattern. All right. You got to level here that we have traded very successfully. On bad days, even, they might not have helped because it's a safe, recession-proof healthcare management company, which has nothing to do with China. So bottom line is, the levels 233, 244. Now, oops, sorry. From a standalone perspective, these are the type of stock one needs to concentrate in, because during times of wild volatility, unless there's a full-scale legislation that says that's it, we're going to restrict the price control. We're going to go into price controls and stuff on health management companies, things like that. That's a different story. But aside from that, this, if you look at this pattern here, you got these shoulders at the 225, 230 level. That's out of the way right now. What we're looking at right now is this. It's a cup. There's your handle. Anywhere between 235 and 241, if the stock breaks out, and something happened a couple of times in a row and it looks pretty solid here, is it broke above the 50-day moving average. See that?
Mm-hmm.
Yeah, that's really important to keep in mind. 50-day moving average. So it is attempting to break above. What's the depth of this, sir? This is 240. That's where I was buying the 242 and a half calls. 250.
Five or six.
It's 234, 243.
6, 7, 8 points.
Yeah, 234, 243, like 9 points. This is 9. Okay, 243, 234, 9 points. All right. So you got 9 points here. Add the 9 over the 244 break, 243 break. You arrive at kissing the next set of lines, which is basically here.
Yeah, 256, 253.
253, 252, 253. These are the long-term lines, 200-day moving average, 100-day moving average. It also, somewhere around 260, it completes this massive pattern. So one or the other, it seems very likely that the stock at least gets to $260 and completes the pattern. All right. And that also happens to be when it completely broke down, which was around 262, 260. See that? That's where the breakdown. Now, is it going to be easy slog? Nothing is easy, but it looks pretty likely that a couple of months going forward, 250 is very doable. That's the first pattern completion, just so you know. Right there. That's the first one. The next pattern completion comes in at around the 256, 260 level. Options are cheap. They're not crazily priced. And they generally are anywhere between $2 to $3, and you can buy them a little bit out of the money. So this one's another one to keep in mind. Now, on a complete technical basis. Now, if you look at a weekly chart of the stock, this gets interesting. I'm going to draw this right in front of you. That's your weekly downtrend line. Touch this point, right? Perfect. Couldn't be a perfect match. See that? That's really a perfect match right there. Okay. Where does it come into play? Again, the same levels that we talked about. Here and here. And if it breaks that, the stock's making a new high. So this is whichever way you slice it or dice it, this looks like one of those slanted W's with major resistance here, and if a breakout does occur, then obviously you have a neckline here, right there, which is at where's that number? 272. So is it possible it goes to 270? Sure, it can. Maybe on earnings. Check and see what their earnings are. So no. I mean, 272 on earnings means the stock is going to be up $30. No, that doesn't happen with that. This is not Google. This is Humana. So this would be the move on earnings somewhere in that 260 level. But on the weekly basis, this is one of those stocks that one can sit on and say, you know what, forget about this crazy up and down every 15-minute move on the market. Barring any legislation, political legislation against HMO companies and stuff, you have that's the stock will get up there. Okay. So Mike, let me sign off. Running a little bit late here, 11:24. So this was helpful. I will be doing the webinar tomorrow at 8:30 evening. I'll see you then, and we'll talk. All right. You have a good day and enjoy the band.
Okay, you too. Thank you.
You know, get that bass going. All right.
Okay.
Take care, sir. Bye-bye.
Take care. Bye-bye.